what's up, guys? It's Alex here. I know quite a lot of people have asked me to upload a new video after my last one, which was probably 2 or 3 months ago now. So it's quite long overdue. The original idea was actually to make a trade recap video today, but essentially it turned into a bit of a long-winded tangent of POI refinements and complex structure. So I just thought maybe it's best suited as a team feature topic video. So I'm actually recording this intro after I've just made the video. So yeah, I hope you enjoy it, and I'll see you in a minute. We're just very clearly bullish. We're just putting in higher highs, higher lows, all the way up. And so if I just quickly just draw the last few on, we're kind of caught basically within, the higher low here and the higher high here. And so anything within this range here is just internal structure, as the overall daily trend is bullish, right? And so if we were following expectation order flow, we should expect this to do this low here should go on and put in a new higher high, right? But what we get instead is we come up and we actually fail to breach this high. I mean, of course we do wick above it slightly, but we don't close above with a body. And so once we start breaking down, this is clear on the 4 hour here, but we basically change trend to the downside on the 4 hour, which is our internal daily structure. And so once we actually start breaking demand levels and significant structure like this, we can say, okay, with certainty, this low here is a weak low. And it just so happens that it's also equal low, so it's quite obvious liquidity pool just resting below. But either way, if this was just a point and did the same thing, didn't close above this, it'd be the same principle, right? I'd still expect price to come lower than this once this breaks here. And so, of course, within this, there's going to be POIs all the way down this leg that we might get some reactions from, but pretty much we're going to be almost magnetized to this area, right? Because this is where the money is. This is where we have our liquidity point here, which takes liquidity, breaks structures to the upside, which is just below these equal lows and this weak low, acting as our extreme daily demand, right? This large wick here, which is unmitigated. And so it's no surprise that we do come down into this level. And if I just drop onto the 4 hour quickly, we can just quickly see here that this is just a refinement of this daily demand level. And so I can just delete the daily for now. This is just the 4 hour demand level, which is basically acting as our sweep of liquidity here, which is just below these equal lows, which acts as our inducement for this liquidity point. And if I just go one step further out and just look at these 4 hour structures here, we've basically got, if I just look at this here as the 4 hour leg, right, we have where is it? So we have a breaker structure here, and we've got this as essentially one leg. And so of course we have supplies within this leg, but essentially the swing high of the leg is here and the swing low of the leg is here. And so anything again within this is just internal structure. And let's take it one step further and mark out our premium discount on. You can see that okay, we get some reaction from this 4 hour supply zone within discount. But basically what we do is we come up into premium of pricing and mitigate this supply level, which is in premium of pricing. And so we then break structure as expected. We've mitigated this within premium, so that can be expected now. And we have the same thing, right? So we have the swing high here, the swing low here, and this now is our 4 hour leg. And so this can be where structure can get a little bit more complex. Basically, you can see you have like little breaks of structure here, for example, but essentially anything now within this level, within these two blue dots, is again internal structure. And so when you see breaks of structure to the upside here, you see a mitigation of demand here, which is fine. Yet another break of structure here, and you might be expecting, okay, we have demand here. Why on earth is this just melted through? Why is this not held and gone up? Because you might be thinking, okay, the order flow has changed. The 4 hours broke bullish again, and this should go continue with the bullish order flow, right? But all we've essentially done is broken internal structure, and this just becomes a complex pullback and just basically mitigates, once again, a supply level in premium of pricing of the actual true leg. This is the true leg, same as this, true leg, premium of pricing, mitigates this, and we continue down, right? Because we know we've got this weak low here anyway, so we're favoring shorts anyway. And if I just do the same thing, just delete this a second, I'll just go to the 15 real quick. Where are we? Okay. So essentially this was the 4-hour leg. And we've basically, I'll just draw this back on. Sorry, 1 second. Okay, so we have, this unmitigated wick as our 4-hour supply zone, right? And then so on the 15, just go back once again. What we've done now is, obviously we've used this as structural liquidity for this point here, which is nice. But essentially, looking at the 15-minute structure approaching this level here, we can say, okay, we have a higher high, a higher low, and for me, this would be the higher high here. So I wouldn't personally be considering this to be significant structure, because for me, I want clear swings, right? And so when I see just a little bit of a correction in price like this, it's not swing structure for me. It's just, again, internal structure. So this would just be an internal break here, and this would actually be the swing points, with this being the true 15-minute leg. And so, of course, we can still sell from these areas, but for now, I'd be classing it as counter trend to the 15, until this breaks. And so, if I just draw this break on, we actually get the break of structure now on the 15, which is aligned with the trend, right? Because the 4 hours bearish with this supply mitigation within premium of pricing, and now the 15 is bearish also. And so what do we have now? We have essentially a new lower low on the 15. This here is essentially our 15-minute leg, and once again we can draw premium discount onto this, and the same thing applies, right? This is our leg. Anything within this is internal structure, not swing structure. And so within this here, we get obviously loads of breaks. We get breaks to the upside, breaks to the downside, sweeps of liquidity, etc. Breaks to the downside, sweeps of liquidity here, breaks back to the upside, breaks to the downside, numerous breaks all over the place. But essentially, what we want to keep in mind is that the 15-minute is bearish. So we can, of course, trade within this internal structure, but essentially keep in the back of the mind that the 15-minute is bearish. And what do we do again? So this here fails to take out these lows here. It doesn't breach. So if you see this here, it doesn't breach the low. We end up sweeping liquidity and essentially using this as structural liquidity in order to mitigate our supply level, which is in premium of pricing once again. And so if you notice, this doesn't actually mitigate anything overly significant. Maybe on like the 1 minute there might be something there, but for me, marking 1 minute zones to the left isn't the best idea unless they're a refinement of like a 15-minute level or a 5-minute level. And so I won't just have 1 minute zones, all the way up and down. And so basically what we've done is we've taken this as structural liquidity, like I said, mitigated this, and then eventually we've gone on and broken once again to the downside as expected, right? So of course we can take buys within this, but I'm not expecting to breach this level. And so now we've actually broken this low. You can see here we've broken with a body, and we get another break to the upside on the 15 here. And this is where a lot of people might get a little bit confused with swing structure or internal structure. Some people may call internal structure minor structure, but for me, I just like to call it internal. It just keeps things simpler for me in my mind personally, but same thing essentially. And so we break structure here, and you can say, okay, we have nice level of demand here, right? And you can take buys off it, and you can expect huge move to the upside, right? But in reality, all we've done, we've actually broken 15 minutes to the downside here, and once again here, and all we've done is break internal structure to the upside. This here is our new 15-minute leg. Premium discount of this. All we've done is essentially mitigate supply level within premium pricing once again. So we've done the same thing over and over again, whether it's the 4-hour or the 15, it's the same exact thing. And so we can expect this to fail once we mitigate this, and we can expect, let's go back, we can expect this demand, this 4-hour demand, to fail once we mitigate this. So essentially that's why this demand fell through. And so of course we knew about this level here and this liquidity point down here. And so when we see it come to this, this is essentially one of the reasons why looking for buys too soon, you know, from essentially, you don't want to be buying off a weak low. You want to be buying off strong lows, right? Or selling off strong highs. And so I'll just clean this up a little bit. Try to. Okay, so we've tapped our liquidity point down here. We know the daily expectation now is essentially to put in new highs, because following the daily expectational order flow, this has potential to break this high. The only reason it might not is because maybe the weekly is still bearish, which is fine. But if I just go to the 4-hour once again, we can see now we've shot up from this area, which is no surprise. We've broken structure on the 4-hour here, also the daily internal structure, I should say, sorry. So like I said, anything within this and this is just internal structure. So when we see this level here on the daily, this daily break, it's a daily internal break, right? And once again, we're following the money. So we've got a liquidity point here, which took liquidity, broke structure. We had nice inducement for this demand level. And then once again here, we've got this liquidity point now, this demand level, which once again took liquidity, mitigate to the left, same as this. And so we know once we break this structure, there's money down here, right? There's a lot of orders resting within this zone. And so if I just go back to the 4-hour, we can basically refine this level. And you can see there's nothing really here, nothing really here. We have this unmitigated 4-hour wick just down here. And yeah, so we've broken structure to the upside here. And when you break structure, pro trend, you can expect a pullback. And so where does pullback like to come from? And we can see, okay, look to the left. You see, okay, we reacted to this, which is nice. We also had a nice level of inducement for this point as well. And so once this gets mitigated, supply is being respected, we can expect a pullback. And now, once again, how deep of a pullback can we expect? Because for sure, yeah, it could do this and continue. But what do we know based on what I mentioned here? It likes to do. If this is our swing low and this is our swing high, anything within this is internal structure. We can put our premium discount on of the leg, and we know price is likely, before this breaks, it's likely to come into discount of pricing before shooting. Now, of course, it doesn't have to do that, but we can keep that in the back of our minds, and we can just, all we have to do now is just mark out our 4-hour demand levels, right? If we want to catch the pro trend continuation, all we need to do is mark out demand levels. And of course, we have this one at the bottom here, which we can refine once again on the lower time frames in a minute. But for now, we're still on the 4-hour, and so if I just draw we have, you know, this unmitigated wick here, and if I just draw this line on actually where the breaks of structure were, you can see, okay, what caused the break of this structure? We do have this huge inside bar here, and we essentially have a 4-hour flip zone at this level here, which is fine, and kind of a bit of consolidation here. There's probably some demand levels within this area here. This isn't the strongest, and then we've got this huge push from this area here, right? And so let's go down to the 15 now. We know the 4 hours bullish, but once we actually get this, I should mention this 4-hour internal break, right? So we know the 4-hour trend is bullish, but internally we've broken 4-hour structure to the downside. So we can expect, once this breaks, potentially a deeper correction. And so now if we go to the 15, okay, so if I just clean this up a little bit. Okay, so we know this was the first 4-hour demand level, right, before the break of this structure to the upside. And so if I just refine it a little bit on the 15, we can see we've got this huge wick here, and the key thing to note is it's a wick, let's delete this as well, it's a wick that takes liquidity. So for me it's a liquidity point, and we can take it one step further actually, because it's just a huge area, right? We're going to get numerous reactions off it, which we do. We already get reactions off it here and down here. But if I just go down to the 1 minute real quick. Okay, so we can see this is the 15 minute zone, right? But then what actually takes liquidity? What takes this structure here? We can see on the 1 minute we have this unmitigated 1 minute wick, which is acting as our 1 minute liquidity poi, because it took this liquidity here and then went on to break structure. And it's not a 1 minute demand zone in no man's land, it's within the 15 minute, within the 4 hour, and so we know it's a great zone to be looking at. So I can just drag this out. Okay, 1 second. Okay, I'll go back to the 15, 1 sec. Okay, so we can see now at this point here, we've essentially tapped into this liquidity poi perfectly. And of course we get some reactions here at the 15-minute zone, but essentially we don't do anything, we don't get any clear impulse or clear aggression into the market until we actually reach the refined liquidity poi, because it's where the money is, right? And so we get the aggression from here, and if you look at this basically as another version of a flip, essentially it's the exact same principle as a supply and demand flip, but it's just on a larger scale. And so in this case, it's the same thing. We have a reaction point, we have our reaction leg, and then we have our failed reaction here. So we fail the reaction. And so once this failed reaction actually happens, you know, we get this break here, and essentially this demand fails. I'll just zoom out a little bit. You can see, okay, go back to the 4 hour quickly. At this point, yeah, we know the 4 hour internal structure has broken to the downside. And you can kind of see what's happened here. Of course, we've got this flip zone to be thinking about as well. We might get some nice long plays from here, but essentially the internal trend has switched bearish. So we can keep that in mind as well if we are to take longs from this area, because we don't want to just stick to the 15-minute trend specifically, because if we only follow the 15-minute trend, we'll get lost in structure, basically in terms of like the higher time frame intentions, same way I mentioned over here, getting lost just purely on the 15-minute breaks and demand levels not understanding the bigger picture and understanding why this move happened here, for example. This is why using the time frames in conjunction with one another, because essentially it's just all price, right? Everything's the exact same, it's just shown differently on different time frames. And so we don't want to just specifically say, okay, the 4 hours bullish, the 15's bearish. We want to look at them together because it's all just the same price. And so if we were looking at basically what caused these failures, what caused this demand to break here, we can say, okay, this is the reaction point, right? This is the extreme of the reaction. And we can look at our levels on the 15, for example, which caused the break, right? So we can say, okay, we have an unmitigated 15-minute wick here, which is fine. Came very close there, didn't quite touch it. And we have this wick here, right? And we can take this one step further and just go into refinements once again. So I'll go to the 1 minute. And so if I just look at this here, basically what happens here, this is the reaction point, this is the extreme of the reaction. And what we can notice is, okay, we are taking liquidity here and we're essentially mitigating to the left here. And we're doing the same thing here. We're taking liquidity and mitigating to the left. And then it's the same thing here. We take liquidity here and again mitigate this. So we're just following the money basically. We take liquidity, mitigate to the left, take liquidity, mitigate to the left. We mitigate this, which mitigates this. And so this 15-minute zone, we can see this is an inside bar here, which is unmitigated, and below here, obviously this just doesn't mitigate this. And this 15-minute zone here does the same thing. And so it's really important to note that these are both liquidity points. They both take liquidity. So we can essentially refine this because this here mitigates this. So instead of marking this one, we can mark this one. And that's fine. So go back to the 15. And so we know we can keep these in our minds as potential points of interest for sales, right? And so of course we can't ignore where we are. We're in this flip zone. I know we're not in discounted pricing, but we are in a pretty significant 4-hour flip zone. So we can expect some reaction from this area. Whether it's the one to hit the moon, like I say, I'm expecting it to come really into discounted pricing, and we know down here is where the money is, right? We've got liquidity mitigations here, liquidity poi, down here, which is the higher time frame demand, daily demand, and so this is basically the best level to be looking for longs, for long-term longs. But of course, we can still take intraday plays from these levels. And so if I go back to the 15, we do get actually some nice longs here, but I'm going to talk about 2 shorts that I took, because this did start out as a trade recap that I was supposed to do, but it's turned into a bit of tangents, I guess. So yeah, I'm going to go over 2 trades basically. And so if I just look at this now, reacting off this huge level, right, this 4-hour flip zone, you get a nice 15-minute break of structure to the upside, because at this point we're just putting in lower lows, lower highs, lower lows, lower highs on the 15-minute, right? And now we've switched 15-minute is bullish. But just because we've reacted off this huge 4-hour zone and now the 15-minute switch bullish, it doesn't mean, okay, this now is going to hit the moon, because we've got to bear in mind the trend, right? The 4-hour trend is, or the 4-hour internal trend at least, is bearish, right? We've broken this structure here. So until we actually breach, if I go to the 4-hour a second, until we actually breach this level and break this, I'm not convinced that this high is gone, because at the moment we've come up like this, and we've essentially reacted here and then pushed down, and so until this breaks, yeah, for me, the internal structure is still bearish on the 4-hour, right? So a 15-minute break into the upside, it's fine. We'll get some nice intraday plays. And we can just keep in mind that, okay, the bigger move is likely to be the sell at this point. Even though overall we know we've broken structure here on the 4-hour and the daily as well is bullish, just because the higher time frames are overall bullish, we can't ignore what the price is doing right now, right? And so we've got our refined zones, which are both liquidity poised. They've both taken liquidity, so we know they're both good levels. And liquidity poise will always give, or pretty much always give, some form of reaction at least, because of the fact that they've taken liquidity. There's money involved, huge money involved, and so we'll at least get some form of reaction, right? So I didn't actually personally take these longs. I missed them from down here. I think around the London lull. I didn't personally take these, but what I did do is take 2 shorts from here, right? So we know we've got these zones, and we've essentially got, if I just look at this, we've got a breakup structure here, and this indicates that this is actually a strong structure, right? Because it's broken this, and so this is just perfect inducement for this level here. And so when I say about inducement, I don't just mean if we're trending down like this, we're coming into, let me just move this up a little bit actually. For inducement, if we're just trending down like this, and we're coming into a demand level, for example, for me, this here, this is not liquidity. This is not inducement. I mean, yes, there's obviously liquidity below every single low, but in terms of inducement for a POI or a demand level, it's a slight difference. But what I'd need is essentially a strong level that breaks something. And so when we come down now into this level, now we've had inducement. This is inducement of structural liquidity, and it's structural liquidity because it's broken something. And so it's a slight difference. And so this here is nice, strong structural liquidity. It's structural inducement for this zone here. It's really close to it. It's not all the way down here. So sometimes you might think, if this is a POI here, for example, and let's go back up a second actually. If this is a demand level here, and we've got big push up, and we've got equal lows all the way up there, way far away from the demand level. Yeah, it's liquidity, sure, it's resting liquidity, but it's not an inducement, right? It's not an inducement for this POI. An inducement will be close to it. It'll be right there, literally getting swept and gone, or it'll be right here, literally getting swept and gone. So of course, liquidity and inducement is just a slight difference, at least the way I look at it. I want it to be relatively close to the actual zone to be classed as an inducement. And so we know we've got these 2 zones. We know overall the 4-hour internal structure is bearish. And so once we actually push up and we take this liquidity here, mitigating this, which also took liquidity, we can go back down to the lower time frames, go to the 1 minute. And for me, I was actually happy to take this as a seconds entry because of how refined the zones were. And I know if the 1 minute refined zone within a 15-minute zone, which took liquidity, had inducement, it's meeting all the criteria, right? We know we're expecting, I know I'm expecting a deeper pullback, and so it's going to come for me, in my eyes, from either this zone or this zone. And I don't know for sure which one. And so what I'll do is, or what I did, is play the reaction at the decisional, and I set a risk entry at the extreme. And so if I just go down to, I believe it was the 15 seconds, we mitigate this perfectly, right? We've taken liquidity of that structure, mitigated this, and last line of demand would be this wick for me. You could argue this wick, but for me, where's the structure break? It's already broken at this point, so this is come after the break. So for me, it's this. And so once I saw price tap into this, we get a reaction point. We then get the extreme of the reaction and the reaction failure. So we have a perfect flip. We have perfect mitigation, perfect liquidation of that structure that I mentioned, and now a perfect flip. So this is where I took my first trade. I believe it was 3 pip stop. Something like that. And yeah, so I was happy to enter on the seconds chart because of basically what we've mitigated. I'm not going to enter a 15-second trade, you know, in no man's land, but for me, it met the criteria for an entry, and it was in such a great zone, so I was happy to take it. And this one, in the end, actually took me out for a break even. So I got the risk off the table at 4R, took a partial, it came back up. Put it on a little bit. Came back up, hovered around a little bit, pushed away again. I mean, it came down, it was running, you know, decent profit. Yeah, bottomed out around, you know, 8R almost. But essentially, it went on to take me out. But also, whilst I was in this trade, like I mentioned before, I actually had a risk entry on this level. And so I don't often take risk entries. So I had this one was actually a 3.5 pip stop, I think. I don't often take risk entries, but because of the fact this is the very extreme point now. If this breaks here, then we can start seeing higher prices, and this can go, and we can then, you know, follow the 4-hour true order flow. So when I say true order flow, I mean this is the true leg, true pullback, and then the true second leg, right? And so this is when this breaks. And so I know this is the extreme point. It's the last line in the sand, it's the last line of the fence, because it's also the extreme of the reaction point. This gets mitigated with this, we take liquidity, mitigated with this, take liquidity, and so it's also a liquidity poi. And so for me, I was happy to accept the risk of a risk entry. And so if I just play this on a little bit. So this took me out for break even, like I mentioned. We get immediately tapped into this trade. And then it's about targets, right? Once we're in this trade, I cover the risk at 4R, but where am I getting out of this trade? And so the first target for me was actually this low itself, because for all I know, it could come down, you know, mitigate somewhere in here and go on. So as long as I got risk off the table, that's fine. If it does that, no problem at all. But in terms of taking profits, I'm expecting this low to go really before I pay myself. So I'll just play it on a little bit. We've pushed down, ranged around a little bit. I think this is during Asia. And then this is the following day, right? So there was a lot of nice sells the following day as well in order to get into this trade. But to be honest, I was happy with the original entry. I did actually miss a scaling either here or here. I can't remember which one. I did miss a scaling. But basically, once we actually broke this structure and we've hit the first target, once you've broken this structure, I'm thinking, okay, this low here is done. It's gone. And the reason is because if I go back to the 4-hour, like I mentioned before, this is the 4-hour high. Yeah, we've got a bit of corrective price here, but essentially this is just one 4-hour leg, and this has failed to take out the high, and then we've broken structures and demand levels to the downside. So once we're at this point here, I'm thinking, okay, at minimum, we're coming to here, right? This is the next target. And I'll go back to the 15. And so anything like this or this, not in a million years would I be thinking to buy off these levels. Because of course, yeah, we've broken 15-minute structure to the upside, and essentially there could be some demand within these zones, but essentially we'd be buying off a week low, and also now the 15 here, I believe it does, yeah, 15 here breaks back to the downside. So now the time frames are essentially aligned. So we've got 4-hour internal bearish structure, and now 15-minute is switched bearish. So both time frames are against us to take this, take longs there. And so I'm happy just to ride this down, and this was my next target. I think it was 24 hour, where I took pretty much the majority off. I took 80% off at this low. And so if I just go back to the 4-hour once again, we do actually break. So we get, delete that. We get once again a 4-hour internal break of structure, right? So internally, the 4-hour is still bearish. So I know we're still in this zone here, but we can't ignore this 4-hour internal trend, right? So once we break structure, what can we expect? We can expect a pullback. And so the same way I did here, we broke structure and I marked out my POIs, my supply zones. We can do the same thing here, right? So I'm out of this trade, well, majority is out of this trade now, 80% off. I've let 20% run. It can do what it wants, basically. And we can look to see if we get in any more trades. And so if we just look at these zones, so we have up here, this level here, this 15-minute level, essentially takes liquidity. We have 15-minute flip zone here, it's inside bar, and we also have this level here, this wick, which takes liquidity. And so if I just go down to the 5-minute and just refine these zones. So okay, we took liquidity here. We have a nice 5-minute inside bar, unmitigated, took liquidity. We have nice clear flip zone again, 5-minute zone here, inside bar, took liquidity, and we have this level here. You can argue this one's mitigated. Essentially, we're just looking for reactions. Right? I don't want to be setting risk entries at this. If I was going to set a risk entry, it'd be at the extreme, the same way this one was. And so if there's going to be any sells happening, I'm thinking it's going to be from one of these 3 zones, right? And once again, we can draw premium discount on of the leg. Essentially, we know likely before the low goes that it'll come into premium pricing. Of course, we might come into discount and react off something there. That's fine. But essentially, these are the more high probability supply zones for me, because they all take liquidity and they're all in premium pricing. And so if I just play this on a little bit, I didn't actually trade this day, but I just want to show you basically these POI refinements and why I look for ones that take liquidity, basically liquidity poise, and why I look at them. Because if you can just see here, liquidity poise, essentially we always get some form of reaction. And so each one of these, we get a reaction, right? So we basically have reaction point, we have reaction leg, point of failure, same again here, reaction leg, point of failure, which breaks. And so we basically have flip zones. And so if I just put this on as the extreme of the reaction leg, and the same thing here, the extreme of the reaction leg, and the reaction legs of liquidity poise, of flip zones. And what I'm noticing, if you were looking to get long from these levels, and you might be thinking, okay, we've had this reaction, we've had this break, and you're looking to get long from here, which is fine, it's valid, definitely. But then you notice that it's not coming back, it's not coming to this level right away, and usually that indicates to me that basically they'll be used later rather than right now. And when I say later, I mean when the trend has changed back the opposite way. So just the same way these were used later on, the same way now these, I'm thinking, okay, these will be used later on, essentially. And so if I just play price on a little bit. And also what I mean is when I say later on, I don't mean they'll then do this later and then go. I mean, when it's later on, we'll likely just get a reaction now from these and follow it back down. A reaction from this and follow it back down. I'll just play this on. So that's what's happened here. We get a reaction from this. Fail to take out the high, which is fine. Of course, this is all just during Asia. But like I said, I didn't trade this, and I also didn't trade this coming day. Same thing here. Reaction. And so, of course, it's valid to take longs from these areas, but just looking at what we're actually reacting off, like for example this, before we react to either of these two levels, we react to this. This happens first, right? And so this is significant because this is the extreme supply level within this overall 4-hour internal trend, and it's a liquidity poi, so it takes liquidity and it's our extreme supply. So if you were going to set a risk entry the same way I did here, it would be on this level. So this is perfectly valid to take a risk entry, but I didn't on this occasion as I wasn't trading, but this would be valid. And from these levels, like I said before, play the reaction the same way I did with this. And so if I just play price on a bit more and see, okay, we've now come deeper into this zone. Just make sure, yeah, we didn't actually breach this level, we just came deeper into it. And significantly, we didn't close above the 15-minute structure, we just wicked it. And so straight away I'm thinking, okay, this low here now is potentially a weak low because it's failed to take out structure. We've mitigated the extreme supply of a bearish internal 4-hour trend. We knew already that we're expecting potentially a deeper pullback. Into discounted pricing and potentially these areas down here. And so if I just play on a little bit more, there was some nice sells from here. I didn't take them myself, but there was some nice trades. And so the same thing with this, once we break this level here, the same way we broke this level, I won't want to be buying off anything within this. The same way I don't want to buy off anything within this. And the reason being, just zoom out a little bit, this low has failed to take out this high. It's failed to take out the high, and then we've broken structures to the downside. So at this point here, I'm thinking, okay, this low is done and it can forget about it. The same way, once this broke, this low is done and can forget about it. And so if you were in these trades, or for example, I still had 20% of this on, I wouldn't want to take anything off until at least these lows. And if you're in these, I wouldn't want to take anything off, apart from to cover risk, of course, until at least these lows. And so I'll just play price on. And yeah, we essentially break this low. And we can do two things, right? We can break the low and just continue, with the bearish trend, or we can basically sweep the low and then begin a more complex pullback, or even continue breaking to the upside, right? So one or two things, but either way, one thing was certain is I won't want to be buying off this because we'll at least wick or sweep below this low but potentially break it as well because of the overall internal trend. And so if I just go back to the 4 hour, what we do actually do is break and we continue moving basically. And if I just go back down to this actually, if we just look at the levels within this zone in terms of what we can expect price to react off, we can look for liquidity poise that are unmitigated. And so you can say, okay, we had a liquidity poi here because it took liquidity here, but it was mitigated with this wick, right? It was mitigated with this. So I'm not expecting potential reaction off this one. Same thing here, we have this takes liquidity here, but it then gets mitigated with this. Whereas this one, it takes liquidity, but what's different? We don't, I'll just do this time. We don't actually mitigate this zone. So this is a liquidity point, it takes liquidity, it goes on to break structure, and it's unmitigated, and this would act as perfect level of inducement because it's a strong structure. Like I mentioned before, I want it to break something, it does break something, it's hovering right above the demand zone. It's not all the way up here, it's right above it, and so you can expect a potential reaction from there. In terms of this, yeah, just a mitigation, doesn't take liquidity, same with all this, so it's just this zone really. If I go back down to this level, you can see, okay, this was our daily, this was our 4 hour, and so now 15, we can see, okay, within this zone, we have this, which takes liquidity here. So if I just draw this wick on, you can see this takes liquidity and is also unmitigated. So we're going to get reactions, it's going to be from this zone or this zone most likely when we're coming down. And if I just go down, play price on, we can see we're in this zone at the moment. I'll just zoom out actually. So this zone and this zone, right? We know now we're in discount of pricing, so we can expect now a big move. We can expect this high to potentially go and basically follow the true order flow. And so if I'm looking for long-term longs, or at least medium term to take this high out, I'm going to take it either from here or here. These would be the zones that I'll be looking at because they're both liquidity poise. But we know already this one is a daily and higher time frame one. So this one is favorable, but we can't ignore what happens here. So essentially, yeah, we get a bit of a pullback from this one, that's fine. There's nothing holding price within this level, so we just melt through, and then this one, as expected, is where we react. So essentially, it's just a refinement, so it's a 15 within a 4 hour, within a daily, it takes liquidity. The overall daily takes liquidity, the mitigation takes liquidity, and even if I just go to this level, we weren't expecting really any big moves off these levels to go long, but even just the pullbacks, you can see, like this pullback here for example, it comes from a candle that takes liquidity. It doesn't just come from a random demand. And obviously the entries that I mentioned as well, all the way up here. All reaction points of the flips were essentially liquidity poise. Even this was a liquidity poi here, reaction, point of failure. We have first entry here, second entry here, both liquidity poise here. These three were liquidity poise, all reactions, all flips, and then we get reactions off the flips that happen from these mitigations. And yeah, essentially, when you've got really refined zones and they're logical, they've taken liquidity, they are either a flip, so the interaction between demand and supply, and we have inducement and following the expectation of order flow, and everything kind of aligns. You can get in to these trades and you can hold them, most importantly, because management, it can be quite tricky to master, and for everyone it's not the easiest thing, knowing when to get out or knowing when to cut a trade short, or expect price to go on and do a huge R, for example. But essentially using liquidity poise, knowing you're getting in at good areas, and then factoring in like weak lows, for example, as targets can help massively. And so I knew once I was in this trade, for example, I knew once this broke here, obviously up until this point, so all within the first 10R, I didn't know that this was going to go. So I wanted to pay myself here. I make sure I'm at break even. But once this low broke, you can be relaxed. You can be really comfortable. Go out, enjoy your day, and just leave your trade running. Like it went from 11R all the way to 24, and you didn't have to do anything. So you got 13R, and you didn't have to do anything other than go out and enjoy your day, because you got in at a good level. You did your job right to begin with. And then even if you were to, go on and hold some volume all the way down to either this level here or even this level, I mean, it's ATR, which is a good amount. And obviously this is with a 3.5 pip stop, so it's quite a huge trade in terms of pips. But I wouldn't expect you to hold, all the way down there. I'm not a swing trader myself. And so I'm happy just to target logical areas, target the weak lows, get in again. If I was active at the charts, I'd look to get in again here, and then get out again here. Yeah, and essentially just follow the trend down until we see otherwise, until we see the mitigation. So this is the extreme. So once this is mitigated, I'm no longer looking for sells, right? Once this is mitigated, sells are done. We're back with pro trend order flow. We're looking for longs. And this is where price currently is. And so, yeah, I think I've rambled on enough now. I hope everything I said makes some form of sense. Obviously, if it doesn't, you can message me about it. But I tried to explain it, how I trade, basically pretty clearly. This, as well as my previous video. If you haven't seen that video, I'd say go and watch it. The SD break theory video, that's more based around flips. But obviously there's a lot of content on flips now. I know Sketchy and Alb, and also Brad with the refined content has done a lot of videos and stuff on flips, as well as all the the markups and stuff within Discord. So this video is a bit different with a risk entry, but essentially it's following the same concepts. It essentially was a flip, but it's just a higher time frame flip of a 15-minute. But yeah, I hope you enjoyed it. So yeah, I'll leave it there. Hope everyone has a good week and smashes the markets.